In just 47 seconds, $847 billion vanished from global markets. I didn't plan for this. I didn't want this. But when I discovered what BlackRock was really doing behind closed doors, I had no choice. The cameras captured everything. The room went silent, and Wall Street erupted into chaos that would make 2008 look like a minor correction. What did I uncover that made the world's most powerful asset management firm tremble? I've been Federal Reserve Chairman since 2018. I've navigated economic storms and made decisions affecting millions of American families, but nothing prepared me for what I discovered on November 8, 2025, at exactly 2:17 p.m. in Conference Room C. That's when everything I thought I knew about our financial system crumbled before my eyes. Picture this. I'm sitting across from Larry Fink, CEO of BlackRock, the company that manages over $10 trillion in assets. This wasn't supposed to be confrontational. It was scheduled as a routine quarterly briefing about market conditions and systemic risk assessment. Standard procedure. Nothing unusual. Or so I thought. Fink walked in like a man who owned every building in Manhattan. Confident stride, expensive suit, that particular smile that comes from controlling more wealth than entire nations. He began what should have been a predictable presentation. Market outlook positive. Asset flows stable. Risk management protocols operating normally. But there was something in his eyes, a flicker that didn't match his words. When someone who controls $10 trillion starts hiding things, the entire global economy becomes their hostage. 23 minutes into our meeting, Fink mentioned something that made my blood freeze. Project Alpha 7. He referenced it casually, almost as an afterthought, like someone who just realized they'd said something they shouldn't have. His body language shifted. His confidence faltered. And in that moment, I knew we weren't talking about portfolio optimization anymore. I leaned forward, asked him to elaborate. Fink's response was textbook deflection, corporate speak, strategic initiatives, operational efficiency, but his hands were trembling slightly. Larry Fink, the man who had stared down presidents, suddenly looked nervous. The moment he left the building, I called Dr. Sarah Chen, our chief economist for systemic risk assessment. She'd been noticing patterns for months, strange correlations in trading volumes, unexplained movements in seemingly unrelated asset classes, data points that formed a disturbing picture when analyzed collectively. Chen arrived 37 minutes later, carrying charts that looked like abstract art but told a story of market manipulation to trained eyes. What she showed me was worse than I'd imagined. BlackRock hadn't just been managing assets, they'd been orchestrating them, using their massive holdings to create artificial market movements, coordinating with other institutional investors to generate volatility at precise moments, making billions in profits by engineering the very instability they were supposed to help prevent. They weren't just participating in the market, they were manipulating it. Here's what made my chest tighten with anger. They were doing it using Federal Reserve policy announcements, our interest rate decisions, our quantitative easing programs, everything we did to maintain economic stability. BlackRock was using as insider information to position their trades milliseconds ahead of market reactions. They had turned the Federal Reserve into their personal profit-generating machine. Chen's analysis showed 18 months of transaction patterns, massive position changes occurring exactly 24 to 48 hours before Fed announcements, coordinated selling that created artificial market fear, followed by strategic buying that captured the recovery. Profits estimated at $347 billion, all while ordinary investors, pension funds, and retirement accounts lost value in the manufactured volatility. At exactly 4:43 p.m., I called an emergency Federal Open Market Committee meeting. When dealing with potential manipulation by the world's largest asset manager, you don't take chances with communication security. The FOMC meeting began at 6:15 p.m. I had Chen present her findings, watch faces around the table as the scope of BlackRock's activities became clear. Initial skepticism turned to alarm, then to focused intensity that comes with realizing you're dealing with a systemic threat. Governor Michelle Bowman asked the devastating question, "How much money are we talking about?" Chen's response hit like a physical blow. Conservative estimates suggested BlackRock had generated $347 billion in artificial profits over 18 months, extracted from market participants who believed they were trading in a fair and transparent system. But the money wasn't the worst part. The systemic risk was. BlackRock's manipulation had created artificial correlations between asset classes. When their engineered volatility cycles collapsed, The resulting market disruption could trigger a chain reaction worse than 2008. That's when I made the decision that would trigger everything. I told the committee I was calling Larry Fink directly, immediately demanding answers. We couldn't wait. Every delay meant billions more in artificial profits and increased systemic risk. The conversation lasted exactly 47 seconds. I told Fink we'd discovered Project Alpha 7, told him we had evidence of market manipulation, told him he had until market opening to provide complete documentation of BlackRock's trading strategies. His response was immediate and telling. He didn't deny anything. He simply said, "Jerome, you don't understand what you're interfering with." Those words confirmed everything. BlackRock was operating under the assumption they were too big, too important, and too connected to be stopped. They had appointed themselves as the invisible hand guiding global finance, accountable to no one. I hung up and immediately called our communications director. Emergency press conference, no advance notice, no prepared questions. We were going public with everything before BlackRock could mount a defense, but BlackRock moved first. At 4:17 a.m. Eastern Time, massive sell orders began hitting global markets. Emergency selling. They were dumping positions as fast as trading systems could process orders, trying to exit before the market realized what was happening. Asian markets opened down 12%, European markets followed with 15% declines. U.S. pre-market futures indicated an 18% opening drop in the S&P 500. The Dow projected a 2,800-point decline. NASDAQ futures suggested a 23% collapse. This wasn't volatility, this was financial panic. My phone started ringing at 4:23 a.m. Treasury Secretary Yellen, Bank of England Governor Bailey, European Central Bank President Lagarde. Everyone wanted to know if the Federal Reserve was prepared to intervene, but here's what they didn't understand. This wasn't a crisis we needed to stop. This was a correction we needed to allow. BlackRock's manipulation had created false valuations across every asset class. The panic selling was revealing true market prices for the first time in 18 months. Instead of intervention, we decided to let the market process run its course. For the first time in decades, markets would find their natural levels without institutional manipulation. The press conference began at exactly 9:30 a.m. I looked directly into the cameras and said words that would reshape global finance. The Federal Reserve has discovered evidence of systematic market manipulation by BlackRock, Inc. We are releasing all documentation immediately and referring criminal matters to the Department of Justice. I provided everything we'd discovered, the $347 billion artificial profits, the 18-month manipulation timeline, the exploitation of Federal Reserve policy announcements. I held nothing back. Markets responded by accelerating their decline. BlackRock's coordinated buying programs stopped. Their volatility engineering protocols were shut down. For the first time in 18 months, supply and demand were determining prices instead of algorithmic manipulation. By market close, the S&P 500 had fallen 21%. The Dow was down 2,167 points. NASDAQ dropped 28%. Global markets lost approximately $8.4 trillion in market capitalization. Headlines declared it the worst single-day collapse since 1987. But those headlines missed the point. This wasn't a collapse. This was a revelation. The $8.4 trillion that disappeared wasn't real wealth. It was artificial inflation created by BlackRock's manipulation. The companies, properties, bonds, and commodities still existed. Only the artificial pricing premium generated by systematic manipulation had been eliminated. 3 days later, BlackRock released a statement acknowledging strategic coordination activities while denying wrongdoing. They announced Larry Fink's immediate retirement and promised full cooperation with investigations. But the damage was done, not to markets, which were stabilizing at natural levels, but to BlackRock's credibility. Congressional hearings began the following week. The Department of Justice opened criminal probes. The Securities and Exchange Commission initiated civil enforcement actions. International regulators coordinated similar investigations. The systematic nature of BlackRock's manipulation became undeniable. The most significant consequence wasn't legal, it was psychological. The revelation that the world's largest asset manager had been manipulating global markets destroyed the assumption that major financial institutions were trustworthy stewards. Pension funds began demanding transparency reports. Individual investors moved money to smaller, more transparent fund managers. Market stabilization took 6 weeks, not because of Federal Reserve intervention, but because genuine price discovery is ultimately more stable than artificial manipulation. Asset prices found sustainable levels based on actual economic fundamentals. 6 months later, global markets were trading 15% below their pre-manipulation levels, but with genuine stability. Companies were valued based on earnings rather than algorithmic positioning. The restoration of honest price discovery began reversing economic distortions, creating opportunities for genuine growth. Today, 18 months after that 47-second phone call, I often reflect on the choice I faced. I could have stayed silent and maintained artificial stability that benefited a few at the expense of many. Or I could have exposed the truth, accepted short-term disruption, and restored integrity to the global financial system. Sometimes the most important decisions require prioritizing long-term stability over short-term comfort. Sometimes leadership means accepting responsibility for necessary pain rather than enabling comfortable lies. And sometimes the most powerful thing you can do is simply tell the truth, regardless of who it threatens. The Federal Reserve's mission is to promote maximum employment, stable prices, and financial stability. But all these goals depend on market integrity. When markets are manipulated, the entire system becomes a house of cards waiting to collapse. What I learned from exposing BlackRock's manipulation is that markets are remarkably resilient when allowed to function honestly. The $8.4 trillion that disappeared wasn't destroyed, it was revealed to be artificial. The institutions that failed weren't victims, they were participants in a system that prioritized profit over integrity. The phone call that lasted 47 seconds changed everything, but it was the right call to make.